Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories within corporate filings. And tonight we're diving deep into Stellus Private Credit BDC's latest report, where it looks like they've been busy tweaking their credit agreements. And let me tell you, some of these changes are pretty significant. Before we get into the nitty-gritty, if you love getting these kinds of insights straight from the source, make sure you hit that subscribe button and the notification bell. And hey, we've got a growing community over on Discord where we chat about these things too, so check out the link in the description below. So what are we looking at here? Well, it's a Form 8K filing, which is basically a report of major events that shareholders should know about. Specifically, Stellus Private Credit BDC, or as we'll call them, Stellus, has entered into a material definitive agreement. Think of it as a big deal for the company. This isn't just any update, it's an amendment to their credit agreement, and the changes are quite substantial, and we're going to break down exactly what that means for them and potentially for investors. The core of this filing is a first amendment to their credit agreement. Now, their original credit agreement was put in place back in September 2022, and this amendment, signed on September 10, 2025, makes some pretty big waves. They've essentially gone back to the drawing board and tweaked some of the key terms of their borrowing arrangements. This is a big one. The total amount of money available under this credit facility has jumped from $19.5 million to a whopping $300 million. That's a $105 million increase. Think of it like this. Imagine you have a credit card with a limit and suddenly that limit goes up by over $100 million increase. Think of it like this. Imagine you have a credit card with a limit and suddenly that limit goes up by over 10 funding lenders in Stellus's ability to manage debt and generate returns. Another major change is the extension of the commitment termination date. This is the date by which the lenders are committed to providing funds. It's been pushed out to September 10, 2029. This is great news for Stellus because it gives them long-term certainty about access to this capital. It means they don't have to worry about this credit line expiring anytime soon, which is crucial for planning and executing longer-term business strategies. Following suit, the final maturity date, which is the ultimate date by which all borrowed money must be repaid, has also been extended to September 10, 2030. This gives Stellus an extra year to repay the borrowed funds. This longer repayment period eases the pressure on their cash flow, allowing them to focus more on growing the business rather than just servicing debt. It's a move that provides them with more flexibility. Now let's talk about the cost of borrowing. They've actually managed to reduce the interest rates on certain types of loans, specifically SOFR loans and alternative currency loans. The margin, which is the extra interest charged on top of a benchmark rate like SOFR, has been lowered. For SOFR loans, it's now a range of 2.25% to 250%. For other loans like ABR loans, it's even lower, from 1.25% to 250%. For other loans like ABR loans, it's even lower, from 1.25% to 1.5%, directly improves their profitability. Less money spent on interest means more money available for investments or dividends. It's a significant win for the company's bottom line. They're also changing the benchmark interest rate for some of their loans. They're swapping out CDOR for CORA. Think of a benchmark rate as the foundation upon which your interest rate is built. Different benchmarks reflect different market conditions. This change likely reflects a shift in how interest rates are calculated in the market, and it's important for Stellus to align with these evolving standards. This is another interesting cost-saving measure. By removing credit spread adjustments, Stellus is essentially reducing another layer of fees or interest that they would have to pay. This further lowers their overall borrowing costs. It's like finding a hidden discount that makes your loan cheaper. Finally, they've updated how they calculate their borrowing base and financial covenants. These are essentially the rules and limits within the credit agreement that dictate how much they can borrow and what financial health they need to maintain. Revising these calculations could mean more flexibility in how they use their assets to secure loans, or it could adjust the financial performance targets they need to hit. This is a technical but very important adjustment that allows them to operate more smoothly within the amended agreement. The information in item 1.01 is incorporated here, which basically means all those amendments we just talked about create new financial obligations for Stellus. This confirms that the company is now operating under these new amended terms. This exhibit is the actual legal document detailing all these changes. It's the nitty-gritty, the fine print that governs the updated credit facility. It's where all these important terms we've discussed are officially laid out. And signing off on this significant amendment is W. Todd Huskinson, who holds some pretty key titles: Chief Financial Officer, Chief Operating Officer, and Secretary. This tells us these changes were made at a high level within the company, reflecting their strategic importance. So What's my take on all this? Well, Stellus Private Credit BDC seems to be actively managing its debt and its access to capital. The increase in their credit facility, coupled with extended maturity dates and reduced borrowing costs, suggests a company that is proactively strengthening its financial foundation. It shows confidence from their lenders and provides Stellus with much more room to maneuver. The changes to benchmark rates and credit spread adjustments are smart moves to optimize their cost of capital. However, it's always worth considering the flip side. While more access to capital is generally good, it also means more potential for debt if not managed wisely. We need to see how Stellus intends to deploy this increased capital to truly assess the long-term impact. Are they investing in growth opportunities that will generate returns exceeding the cost of borrowing? Or is this simply about shoring up existing operations? Without that information, it's a positive step, but one that carries inherent risk if the deployment of funds isn't strategic. The company's direction appears to be one of securing more flexible and cheaper financing, which is a sound move in any economic climate. The key risk is ensuring that the increased borrowing capacity translates into profitable growth. Alright, that's our breakdown of Stellus Private Credit BDC's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.